Hey dividend investors, today I'm going to be talking to you about my top 3 picks of Canadian ETFs that pay huge dividends, some even as high as 8 and 9%, which is huge. If you're looking for some great passive income, this is definitely the video for you. Let's go get down and let's check these ETFs out. So this first ETF, its ticker is XEI. And what are some of the great things about this ETF? Well, number one, if I'm looking for passive income, I'm looking for something that pays a very consistent dividend, usually roughly around the same amount every single month. Yes, that's what I said. Every single month. That is very important. I'm also looking for something that has a reasonable price so that you can get a lot of shares. If you have an ETF that's basically trading at $100, $150, $200, that's really hard to get into. Not necessarily what I mean by total money, but if you have an extra $100 left over and you could have got an extra 4 shares and you can't, well, that just sucks. So anything under $20, $25 is very important to me. Next, how long has this ETF been around? That's the next part that is very important to me. And this ETF has been around since 2011, which is a very long time. That's 9 years. The current distribution yield of this dividend ETF is 4.7%, and that's as of November 18th, so that is pretty recent anyways for them to put it on there, and the trailing yield is 5.26%. I personally look for something that's roughly around 5% or better, so that really does fit in with my own personal trading goals. So for those who are wondering what the risk indicator is, it's medium, so it's not necessarily crazy. You're not going to be getting crazy gains or crazy losses in most cases, not including the COVID-19 pandemic, which absolutely sucks. Next is the holdings, and of course, this is what I like to look at, the top holdings. The reason why I want to look at them is, do I agree with the companies that are on there? Do I disagree? Is there a company that I think is going to go under within 2 months or 12 months? If there is, I probably wouldn't want to hold that ETF. However, just like in every single Canadian dividend ETF, there are a few names that you're going to see a lot of, and that is right there. The Canadian banks, they pay always a very high dividend, and of course, that is massive. Next is the telecommunications companies. They pay a high dividend as well, and that's usually why you'll see them in, again, most dividend Canadian ETFs. Something that you will see in a lot of Canadian ETFs as well is the oil companies. And of course, oil companies do pay a dividend. They do pay usually a high dividend, but there is a few things that you need to worry about when it comes to that. And that is, there is a massive, massive undertaking through the world governments right now to make gasoline, diesel, and other natural gas things either illegal or very hard to sell. And we're all moving over to electric vehicles. Within 10 years, you're going to be seeing probably 50% or more vehicles being sold that are electric. You're going to be seeing a lot more transport trucks that are electric. There's a few transport trucks companies in Europe that are starting to go electric, or at least experimenting. Tesla has the Tesla Semi, which is going to be taking a lot of market share. So because of that to me is a risk. However, if they can move out of that holding, which they probably would, because they wouldn't want to lose your money, because when they lose your money, they're losing money that they could make. So I would assume that companies like that and these companies will probably slip down farther, and other companies will start moving up over the next 10 years if you're looking to hold this ETF for that long. So of course, I also like to look at the historical charts of the ETFs, and I really want to see where they move. So what we see here is a massive dip because of COVID. The market moved down just about that much anyways, and so we can really assume that if there's any major movements in the market, it's going to pretty well reflect that, and reflect that hard. That is over a 40% drop, which is scary. It is slowly building its way back up. This would have been a perfect time to buy, but yeah. The next thing I really like to look at is from inception up to its point and where we are from that point to where we are now. And of course, that is a huge 50% jump over the 4-ish years from that point. And of course, then it dipped massively from about 15,000 if you started at 10 down to just over 8, which is a scary drop. Anytime that we've had this much time between a massive drop and the start, and we see that you're actually below your starting point, that's kind of a scary thing to me, but it has recovered nicely, and of course at this point we are still back above the 10,000. It only took maybe a couple of days for it to get back above our initial 10,000. So because it didn't dip too far below our initial investment for too long, I would not worry about this at all. And overall, this is a great ETF to hold. So this next ETF I'm going to talk to you about is ZWK, and I have only owned this ETF for a very short amount of time. And what I mean by that is I'm only into this ETF myself for about 2 weeks, and I'm already up 20%, which is huge. To have that kind of a jump in that short amount of time, that doesn't happen all the time, and that's especially when you're dividend investing. And yeah. But either way, the XIEI, which is what we just looked at, that one is monthly distributions, same as this one. And from there, what we are looking at is a market price currently at $24, and its 12-month high low. Its lowest was 17, highest was 33. And then its annualized distribution yield is massive. It's 9.08% currently. I picked it up a few weeks ago at 10.01%. So that is when something like this comes up, you just want to get in. And of course, that worked out for me. Now from there, I forgot to mention on XEI, which is what we just looked at, it has a 0.2% management ratio. This one has a 0.7, so it is a higher management ratio than the last one by a whole 0.5%, which is huge. That's going to cost a good amount of money. However, when you're looking at a dividend at 9% or 10%, which is where I got it at, that 0.5% doesn't really affect me all that much, especially when we look at the US banks, because that's essentially what this is. It does have a medium to high risk rating because we are looking at an American stock, or at least an ETF that holds American stocks. And then from there, it is a monthly distribution. So you are going to get paid every single month. And for the last couple of years, this ETF has paid the exact same over every single month. So it seems to be pretty regular. So when it comes to what it holds, it is holding these, at least the top holdings are holding different financial groups, different banks from the United States, and it is a covered call strategy, so it is going to be a little bit more streamlined. You're not going to see massive jumps up or down unless you look at the COVID charts, which is, again, COVID is going to be popping up a lot in this video. So year to date, it is down huge. It is currently down a lot, and that can be scary to a lot of people, but grabbing it down when it's down like this is sometimes a good strategy. You don't want to be too scared, but at the same time, you really want to do your due diligence and do your own research. Now, when you look at the 1 month chart, this is huge. You're up massively over that 1 month. Over the 6 month chart, you're actually up over 30%. So this is huge at this point in time. And of course, if you could get in at that point, you are coming away with a massive steal because the dividend there was ridiculous. And then when you start moving to a 1 year or even a full chart, now this is what I like to personally look at. Before a massive drop, what is really uncontrolled. There was nothing that anyone could do about that drop. COVID-19 destroyed everything but the tech sector. And they were up a good amount from the beginning, and this hasn't been around for all that long. It's been around since 2019. So within that less than a year, really technically speaking, about a year, you're up still a good amount. You were up about 10% in that year, and then that massive drop happened. So this is an ETF that we don't have a lot of history on. Of course, you can never go by looking at a history of an ETF to see what the future is going to be, same as any stock or mutual fund. But again, it's always good to see with the history to see if they were losing money for 20 years and then all of a sudden it just tanked and you're like, oh, hey, it seems like a good dividend right now. So that's just how I like to look at things. So now ZWC is my third pick, and with this one, it is another great pick to look at. This is another covered call strategy ETF, so there's not going to be massive jumps up or down minus the whole COVID thing. However, the ticker is ZWC, and when we start looking down along the chart, we look at a dividend that is huge. So this one does have an 8% dividend yield, which is great. It is another ETF that is a 0.7% management ratio, so that is still a bit high for ETFs, but when you are looking at an 8% dividend rate, that's still, you're still coming out way ahead versus a lot of other ETFs. And of course, when you start looking at the holdings, you know that you're going to be getting a good ETF. So whenever you're looking at a Canadian dividend ETF, you're going to be seeing banks a lot. And of course, we see banks again. That's an insurance company. That's a telecommunications. That's another bank. And then we have another bank here as well as here. So, and then an oil company finally. So from there is a lot of banks on this. This is why the dividend is at 8%. Now, any covered call strategy is going to usually have a high percentage of dividend because they get a lot of that yield from selling those calls. That's that covered call strategy. A lot of the premiums they pay out as dividends for the ETF. Now, when we look at the 6-month chart, you would be up 12 or 20% from the start, which was about 6 months ago. Of course, this ETF has been around for a good amount of time. It's been a few years. But now when we start looking at longer out charts, this was from the top down to the bottom, a 40-ish% drop, which is still big. Again, that is roughly where the market went. So whenever there's a big drop like that, that is just going to show up on every single ETF. Now, when we start looking at a 3-year chart, there was a bit of a gain on 3 years. You're up maybe 10% when it comes to a roughly 2.5 years at 10%, which is okay because you're getting an 8% dividend. You're still staying up with inflation when it comes to the price increase, but you're also getting that massive dividend. And then when we look at the beginning, which is in 2017 to April 2020, that's a 3-year and close to 20% gain. That is what we really want to see. It looks to be pretty consistent. There are some massive drops along here, but it is pretty consistent along until, of course, the COVID drop, and then it's recovered nicely since then. It's still not reached the top, which it will probably reach the top again, of course, if lockdowns and things don't continue. I hope that this video has helped you understand these ETFs, and I hope that these ETFs help you make a lot of money because it's making me a good amount of money anyways. So I'll see you guys again next time.